Welcome back to The Explainer. Look, if you're tracking charts, you already know the golden rule. Nothing goes straight up forever. Eventually, the market's got to exhale, right? Well, today we're diving right in to demystify the exact structure of those market countertrends using the Elliot wave theory. We're going to break down the mechanics of what actually happens when a dominant trend takes a breather and show you how to spot the underlying order hiding inside all that apparent chaos. Here's our quick agenda for today. The three-wave countertrend, pattern basics, the zigzag, the flat, the triangle, and finally, trading mindset. Let's get right to it.
Section 1. The three-wave countertrend.
So before we can really dig into a correction, we need to establish exactly what it's pushing back against. Check this out. You've got your classic five-wave trend, the impulse, which is eventually stopped and reversed by a three-wave countertrend. Now, what's really cool here is the labeling convention. We use numbers 1 through 5 to track that primary trend, but we actually switch to letters to track the correction. So you end up with this distinct ABC pattern that clearly stands apart from the dominant impulse. And hey, a quick aside. Just because our examples usually show a bull market as the primary trend, that absolutely doesn't mean this theory ignores bear markets. The exact same 5-3 wave pattern applies, it just looks inverted. A 5-wave downward trend is simply followed by an upward 3-wave ABC correction. The mechanics are literally identical.
Section 2. Pattern basics. Don't panic.
Okay, so we know what a basic correction looks like, but here's where things usually go off the rails for people. According to Elliot, there are 21 different corrective ABC patterns out there. Yeah, you heard me. 21. I know exactly what you're thinking. That sounds completely overwhelming. I mean, trying to memorize 21 intricate chart variations? No way! But take it easy. Seriously, take a breath. You absolutely do not need a photographic memory to trade this stuff, because all 21 of those crazy variations, they aren't actually unique. They're all just built on 3 simple, easy-to-understand foundations. To cut through all that noise, we're going to focus strictly on these 3 core formations, the zigzag, the flat, and the triangle. Master these 3, and you've basically got the cheat codes to all 21 complex variations.
Section 3. The zigzag formation.
Let's start with our first category, the zigzag. These are the aggressive ones, defined by very steep price moves that just sharply bite back against the main market trend. When a market corrects with a zigzag, it's not subtle, it's a heavy, pronounced retracement. Just look at the trajectory here. You get this massive, steep drop in wave A, a tiny little gasp for air in wave B, which by the way is almost always the shortest leg, and then boom, wave C drags the price down even further. It's basically a failed, split-second attempt to resume the prior trend before wave C takes over. And here's a wild detail to keep in the back of your mind. These zigzag patterns can actually link together. They can hit you 2 or even 3 times back-to-back in a single correction phase, just chained together. And since it's Elliott wave, each individual leg of that zigzag can be broken down into smaller 5-wave patterns. It's just fractals all the way down.
Section 4. The flat formation.
Now, if the zigzag is a steep cliff, our second pattern, the flat formation, is a totally different animal. These are simple, sideways corrective waves. The market isn't violently retracing here. It's pausing. It's consolidating. In these flats, the lengths of the individual waves are generally pretty equal to one another. This visual really nails the mechanics of it. It's like a complete wash. Wave B almost perfectly erases wave A's move, bringing the price right back to the start. Then wave C drops down and entirely undoes wave B. Now, we do say the lengths are generally equal because sometimes wave B will push just a hair past the beginning of wave A. But the overall vibe, it's a clear horizontal channel, not a sharp plunge. Section 5. The triangle formation. Which brings us to our third core structure, the triangle. This is where the actual geometry of the market gets super interesting. Triangle formations operate a bit differently. They're corrective patterns trapped inside trend lines that are either squeezing together or pushing apart over time. Check out the anatomy of this thing. Unlike the standard 3-wave ABC stuff we just saw in the flats and zigzags, these triangles are actually made of 5 waves, labeled A, B, C, D, and E, grinding sideways against the trend. Depending on the angle of those boundary lines, they can be symmetrical, descending, ascending, or expanding. But what it really represents is a massive tug-of-war between buyers and sellers before that primary trend finally rips back into action.
Section 6. Fierce and original trading.
All right, so we just took 21 intimidating patterns and boiled them down to 3 basic visual building blocks. Suddenly, it's not so bad, right? I want to share this fantastic quote from the novelist Gustave Flaubert. He said, "Be steady and well-ordered in your life so that you can be fierce and original in your work." That perfectly captures how we should read charts. Having a steady, well-ordered framework to categorize the chaos is exactly what lets you be fierce, original, and incredibly confident when you trade.
So, as you pull up your next chart and watch it dominant trends start to stall out, what's it going to be? Are you going to let the complex, chaotic movements of the market trigger your panic? Or are you going to take a breath, spot the zigzags, the flats, and the triangles, and actually find the order in the waves? Thanks so much for joining me for this explainer. I'll catch you next time as we keep decoding the charts.